96 years separate us from 1929, 17 years from 2008. The distance isn't random, it's structural. A Russian economist discovered that modern economies move in long waves lasting half a century, driven by technology, debt, and human psychology. His reward for this discovery? A firing squad. But his cycle survived him, and it's happening again. Welcome to the Wealth Timeline, where we uncover how money, power, and history intertwine to shape the world we live in. The year was 1925. While the world celebrated the Roaring Twenties, a young Russian economist named Nikolai Kondratiev was analyzing wholesale prices, interest rates, and production data across 4 major economies dating back to 1790. What he discovered would ultimately cost him his life. Kondratiev identified long waves in capitalist economies lasting approximately 50 to 60 years, consisting of alternating intervals of high growth and decline. He published his findings in The Long Waves in Economic Life in 1926, documenting 5 complete cycles since the Industrial Revolution. The first cycle ran from 1780 to 1830, fueled by the steam engine and textile manufacturing. The second, from 1830 to 1880, was driven by steel and railroads. The third, from 1880 to 1930, arose from electrical power and the chemical industry. But Kondratiev's theory posed a dangerous question. If capitalism moved in predictable waves, could its crises be foreseen? By 1928, he had lost his position as head of the Institute of Conjuncture. In 1930, he was arrested during one of Stalin's purges, subjected to a second trial in 1938, and executed by firing squad on the same day he was sentenced to 10 more years. Stalin silenced the man, but he couldn't silence the cycle. 3 years after Kondratiev's arrest, the third wave reached its breaking point. October 1929, the cycle kept its appointment with history. Between 1929 and 1932, worldwide gross domestic product fell by an estimated 15%. In the United States, GDP contracted by 30%, but the numbers don't capture the human devastation. Real GDP shrank 29% from 1929 to 1933. The unemployment rate rose from about 4% to a peak of 25%. Nearly 7,000 banks, approximately 1/3 of the banking system, failed. Consumer prices fell by 25%. Wholesale prices plummeted by 33%. This wasn't just recession. This was deflation spiraling into depression, where falling prices incentivized hoarding cash, which reduced demand, which drove prices lower still, a death spiral that conventional economics couldn't explain or stop. The gold standard, which bound global currencies together, transmitted the contagion across borders with ruthless efficiency. In Germany, unemployment reached nearly 30%, fueling political extremism that paved the way for Adolf Hitler's Nazi Party to rise to power in 1933. The Great Depression lasted a decade, only ending when World War II manufacturing production increases finally pulled economies out of the abyss around 1939. Kondratiev's fourth wave, driven by petrochemicals and automobiles from the 1930s through 1980, brought recovery, then boom, then the familiar arc toward excess. The fifth wave, powered by information technology and telecommunications, began its ascent in the early 1980s. And then came 2008. On September 15th, 2008, Lehman Brothers collapsed. A deputy governor of the Bank of England called it a once-in-a-lifetime crisis and possibly the largest financial crisis of its kind in human history. But this wasn't unprecedented, it was predictable. From peak to trough, U.S. gross domestic product fell by 4.3%, making this the deepest recession since World War II. It lasted 18 months. The unemployment rate more than doubled from less than 5% to 10%. The trigger was different, subprime mortgages instead of stock speculation, but the structure was identical. Excessive risk-taking, over-leveraged institutions, and the bursting of an asset bubble led to a shadow banking system run, causing massive failures across investment and commercial banks. 18 large financial institutions were responsible for over half of all losses reported globally. The American public lost heavily as 1 in 5 workers lost their jobs. The interconnected global financial system meant contagion spread faster than in 1929, but the pattern remained unchanged. Central banks responded with unprecedented intervention, trillions in bailouts and stimulus. Yet a decade later, many countries still operated at output levels below pre-crisis trends, and approximately 85% of economies that experienced banking crises remained damaged. The fifth Kondratiev wave had reached its breaking point. The question now, what happens when the sixth wave matures? It's 2025. Real gross domestic product is expected to slow to 1.4% in 2026 from 1.8% in 2025, with growth then rebounding above 2% in 2027 before slipping below 2% through 2030. The signals are mixed but troubling. The Conference Board leading economic index for the United States declined by 0.5% in August 2025, falling 2.8% over 6 months, a faster rate of decline than the previous 6-month period. J.P. Morgan sees a 40% probability that the U.S. and global economies will enter recession by the end of 2025. Others see asset valuations at levels paralleling the dot-com bubble, corporate bond spreads near all-time lows, and house prices at record levels, while unsold inventory climbs to levels last seen in 2009. The sixth Kondratiev wave, driven by biotechnology, artificial intelligence, and green energy, began around 2005. We are now 2 decades into its life cycle. If the pattern holds, we're approaching the mature phase where excesses accumulate, vulnerabilities multiply, and the system becomes fragile. History doesn't repeat, but it rhymes. The Great Depression came at the peak of the third wave. The 2008 crisis marked the transition between the fifth and sixth waves. Both occurred when debt levels were extreme, asset valuations were stretched, and confidence in perpetual growth was unshakable. Today, private credit markets have exploded with risks that regulators don't fully understand. Cryptocurrencies represent purely speculative capital on an unprecedented scale. And artificial intelligence investment mirrors the irrational exuberance of previous technological revolutions, from railroads to radio to the internet. The cycle doesn't require belief. It only requires time. 3 truths emerge from the timeline of economic storms. First, long wave cycles are not mystical prophecy. They're the mathematical consequence of how human societies adopt transformative technologies, accumulate debt during boom periods, and purge excess during contractions. Second, each crisis arrives with different characters but identical structure. Different assets inflate, different institutions fail, different governments intervene, but the underlying dynamics remain constant. Third, the pattern continues whether we acknowledge it or not. Kondratiev saw the wave and was executed for his vision. Yet 1929 came, then 2008, and the mathematics suggests we're entering dangerous waters again. The sixth Kondratiev wave will eventually reach its reckoning. The only questions are when, how severe, and whether this generation has learned anything from the previous 90 years of cyclical devastation. Because in the timeline of wealth, every rise comes with a hidden cost, and the bill always comes due. If you enjoyed uncovering this hidden story, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because history's next secret is already unfolding.